Welcome to today's podcast. Today, what we're going to be discussing is what is sometimes a controversial subject in the infinite banking world. And what we're going to be talking about today is the difference between direct versus non-direct companies. Anthony, you mind jumping in and telling our listeners what the difference between these two is?
Yeah, the main difference is how they pay dividends with policies that have loans on it. Okay. Now, if we take a kind of bigger picture on why there is a difference, remember when we take a policy loan, we're not taking it from their policy, we're taking it from the investment arm of the insurance company. And that investment arm takes all the money that they have and they put it to work. Sometimes, or most of the time, they can put it to work, earn a higher rate than what the loan rate is. Now, when they do that, that means they're going to earn less money when they have a policy loan. So the question is, okay, who absorbs that cost? Then on the flip side, sometimes the loan rate's higher than the earnings rate. So then there's an actual benefit. So who gets to enjoy that benefit? In a non-direct company, it doesn't matter. Everybody shares in the burden and in the fruits of that difference. However, for a direct recognition company, they directly recognize whether you have a policy loan or not. So what they will do is if the portfolio rate's higher than the loan rate, then that additional cost is going to be absorbed by people who have policy loans. And they do that via a lower dividend rate. And then the opposite happens when the portfolio rate is less than the loan rate. People with policy loans get a higher dividend. But one key thing to note is that dividend rate is the difference in the dividend rate is only on the amount that you have a loan against. So let's say, for example, your cash value is $100,000 and you have, let's say, $60,000 as a loaned out. You're going to get an adjusted dividend rate on the 60, but on that 40, you're going to get the full interest rate or the full dividend rate.
Yep. And conversely, with the non-direct recognition company, right, you're not going to have any adjustment in the dividend, right? Mm-hmm. That's what I just heard you say. So is it fair to say that after hearing kind of those two definitions, you think most of our listeners would hear that and say, well, maybe I should just go with a non-direct recognition company?
Yeah, that's the first thought.
Yeah.
Right? Particularly now because the portfolio rate is more than the loan rate. So typically right now, direct recognition companies are getting lower dividend. So your first reaction, which was mine, is, well, then why would I work with a direct recognition company? And when we first got into this business, we were told that it didn't matter, right? And I know at the beginning we took whatever our mentors told us, right? But then as we got more experience, we started developing our own opinions. And about a while back, we did the math.
Yeah.
Okay. We did an illustration. We just compared two. One using a direct company and one using a non-direct company. And we compared the cash values. What was interesting, the direct company, right? The company who may pay a lower dividend, who we're considering that we shouldn't use IBC for, had more cash value. Okay. But then we're like, well, that's not completely accurate because our clients are going to be using policy loans all the time. Mm-hmm. So what we did is in that illustration, we took a max loan every year. And so that way we could determine what that impact on the current dividend rate is. And we did it, I think, to age 70. And the cash value was about equal. Right? So that gave me comfort. Okay, then what they're saying that doesn't matter, it really doesn't.
Right.
Right? So that provided us comfort, and all I sat and looked, I'm not going to have my policies max loans.
Yeah, I was just going to jump in there, and I was going to say we rarely ever have a client that has a max loan on a policy, right? And so if that's the case, what are maybe some options for us to consider moving forward?
Well, we had a podcast, and I don't know when when it'll be posted, but we did one on using what's called an life equity line of credit.
Mm-hmm.
Like you've heard of a HELOC, home equity line of credit. This is a LELOC, right? Same concept. Because remember, when we're taking a policy loan, we're not taking it from our policy. We're taking it from the insurance company. They're using your policy as collateral. Banks will do the exact same thing. They'll use your policy as collateral, and you borrow from the bank. So in that scenario, Cameron, if you're using this life equity line of credit, do you have a policy loan?
No.
So then what happens to that dividend?
You receive the full dividend.
You get the full dividend.
So let's recap here real quick if we can, right? So direct versus non-direct. Non-direct is they're going to pay out a dividend regardless of whether you have a loan against your policy or not, right?
Mm-hmm.
The direct recognition is going to recognize you have a loan against your policy, and then they will adjust the dividend that you receive based upon the amount that is outstanding as a loan, right? And so what we did is we sat these side by side, ran them out, and we realized that, hey, if we put a max loan on a direct recognition company, it runs very similar, almost negligible difference between the two to a direct recognition company, right?
Exactly.
And so now the consideration is, okay, well, how can we get this direct recognition company or access to the same money? Is we can go use a third party, which is a bank in this scenario, instead of taking a loan against our cash value with the insurance company. And so if we were to do that, Anthony, what we just talked about, life equity and taking a loan against the policy, who do you think would be the winner there?
Well, in the scenario we looked at, the winner would be the direct recognition company.
Right. And did you mention this, is that if you run them side by side, the direct recognition company will typically illustrate better?
Mm-hmm.
Awesome. Perfect.
Yeah. So I think the point is there should be a lot going in to what sort of company you should be using. We get calls where they want, well, this company has a higher dividend rate, or this company has this, or this company's direct or non-direct. Hopefully we made it clear that direct or non-direct really is not that big of a deal. But there should be a few things going into what company we should use. And Cameron, you want to expand on some of those things?
Sure. Let me list maybe 4 or 5 of some of the things that we actually will rank as a bigger difference or more importance than direct versus non-direct. Is number one, what we look for is we want to make sure that we're doing business with a mutual insurance company as opposed to a stock company. The difference between those is this: is at the end of the year, if you can have 2 insurance companies that have the exact same products, operate the exact same way, and with a stock company, at the end of the year, when they realize a profit, those profits get paid out to the shareholders, which is usually a select group of people. And then if you look at a mutual company, when they realize a profit, is those profits get paid out to the owners. But with the mutual company, the policy owners are the owners of the company as well, and so they get paid out what's called the dividend. And so first we want to do business with mutual companies. Mm-hmm. Then number 2 is if we're looking at a mutual company, we want to make sure that they have a excellent track record of paying out dividends, and we want to make sure that they're paying out healthy dividends, and they've been doing it for a very, very long time.
So ideally, these companies are over 100 years old, right? So they pay dividends every one of those 100 years.
Yep.
So that means, did they pay dividends during the Great Recession?
They did.
Did they pay dividends during the Great Recession?
They did.
Did they pay dividends the last time this country saw a pandemic in 1918?
They did.
Right? So if they were profitable during these worst times the world's ever seen, we believe they're in the best position to be profitable in the next crisis we have, which I believe we're in right now.
Yeah, totally agree with you. And then just moving on, the third topic or the third criteria that we will typically look at is really the financial stability of that insurance company. And there are a whole bunch of rating agencies that will rank all the major insurance companies that are out there for us. And so what we do is we will pull these ratings provided to us by those agencies, and we'll rank them and we'll look at them. And kind of our criteria is we want to do business with that top tier of mutual insurance companies that are out there. And then probably the fourth criteria that we look at is really the loan provisions. A lot of what we do is really based upon our access or our opportunity or our ability to take a loan against our cash value. And sometimes insurance companies will place restrictions on that cash value, whether we can take a loan in the first year. Sometimes we can't. Sometimes they'll charge us a higher interest rate than other companies in the market. And so we always want to look at that. It's a really, really important piece to what we're doing here. And then the other thing that I'll share there is, I think my fifth topic would really be policy design. Policy design, in my opinion, is much more important than direct versus non-direct. And if you look at what people are trying to do when they're funding a policy, is sometimes they come in and they have a big dump in that we want to try to get in as much money into the policy the first year as we can. And some policies with certain companies are better suited to handle those type of dump ins as opposed to other ones. Sometimes somebody, take us or myself, for example, business owners, sometimes we need a whole bunch of flexibility in the policy that we're putting in place. Flexibility for the billing mode, whether we want our base premium on one mode and the PUA on another, or the flexibility in those PUA riders. Maybe some years we want to pay it, some years we don't. Maybe we want to have some catch-up provisions that are in there. And so those would be 4 or 5 things that I would absolutely rank as more important than the direct versus the non-direct. When I see the direct versus non-direct really get played up is typically in some sort of competitive scenario. When somebody comes in and they're looking at what somebody has, they'll come in, well, you've got a direct recognition company. Here's the problems with this, this, and this. You need to be with the non-direct recognition company. And that's really where I see kind of this whole argument in our industry being kind of generated from. And if you look at it at the end of the day, not either of them is right or wrong, right? They're both tools and they have their own place.
One of our mentors, we've had him on the podcast before, Todd Langford. One thing he talks about, there's no deals in life insurance.
Yeah.
Right? They use actuarial science, and there's a give and take. There is no special deal.
Yeah.
Right? And as part of the criteria for becoming a certified infinite banking practitioner is reading a book and taking a test. And one section of that actually dove deep into the difference between direct and non-direct. And so basically what I say, if somebody comes to me and is like, oh, well, we can only use, first of all, if they say only blank, then I know something's up, right? Because there's a lot of pieces going on like you had recommended. But if we want to follow and practice infinite banking, if we ever have any questions or concerns, we go to the source. And the source is the book, Becoming Your Own Banker. If you haven't read it, I highly encourage you to do so. And here's the question, Cameron. In that book, Nelson used some illustrations. The company he used, was it direct or non-direct?
Nelson used a direct recognition company.
Okay, so the founder of the infinite banking concept used a direct recognition company.
He did.
So I don't have a mic, or I do, but it's on here. But like to me, that's a mic drop. Like the founder of this concept used a direct recognition company. So why would you have any sort of concern?
The only thing I'm going to add in there is what you said about Todd Langford. There's no deals in the life insurance industry. And if you think about it, if there was a benefit to doing one of them, all the other companies would have realized that by now, and all of them would be doing direct recognition if it was so much better than non-direct, and vice versa, right? And so it's really just a means to an end. Both of these things work, and they both have their place.
In regards to Todd Langford, he did a couple blogs on direct versus non-direct, so we're going to include that in the show notes along with a couple other resources.
Awesome. Thanks. We'll also include our typical show notes in there so you guys can enjoy it. Thanks for listening.
Make it a fantastic day.
Take care.